Hi everyone, I'm the Tax Pro, and it is day one of 90 days to taxes. And what that means is we are going to start getting you organized and ready for tax season. First thing we're going to do is talk about how you are taxed. And this may seem like a simple exercise for a lot of people, but it's really important to understand. A lot of small business owners actually don't understand exactly how they're taxed. If you don't understand your tax treatment, you don't understand what taxes you're subject to, how those taxes are calculated, what forms you need to file, due dates, etc. It's really important. So the first thing we're going to do is dive into that. Now, there's 4 different types of tax treatment for for-profit businesses. Okay, 4 different types of tax treatment. The simplest one is a sole proprietorship. That's what I'm going to go over first. A sole proprietorship is one owner, okay, and it does not have to be formally formed. Like, there does not have to be a true legal entity in order for you to have a sole proprietorship. A lot of people get confused because they think that, their legal entity is exactly how they're taxed. And while our legal entity can help us determine default tax treatment, it doesn't actually tell us exactly how we're taxed. For example, I have a lot of people that come to me and they say, I'm an LLC, and that gives me zero idea about how you're taxed because it can literally be taxed all 4 different ways. Okay, so you don't have to have a formal legal entity in order to form a business with the IRS. And I'll go over this tomorrow, how we register with the IRS, etc., for taxation. But you don't have to have a formal entity. You can just go and start making money and say, I've opened a business, and there does not have to be any sort of formal documentation behind it. If that is the case and you go and do that and there's one owner, by default, you are taxed as a sole proprietorship. An LLC with one owner is by default taxed as a sole proprietorship. Okay, so if you have no legal entity, if you're an LLC, and there is one single owner, by default, you're a sole proprietorship. Sole proprietorship is the simplest form of a business return, and it is the most common that we see. So a sole proprietorship is going to file Schedule C, which is right here. This is part of the owner's Form 1040. So there's actually no separate business tax return. It's just a schedule that sits on the owner's Form 1040. This is what it looks like. It's pretty simple. There are some schedules that go along with it, but in comparison to the other business returns that I'm going to show you, this is going to look fairly simple. So Schedule C is the most common form filed for sole proprietorships. However, we may see sole proprietorships file other types of forms. If it is a farming business, Schedule F is filed instead of Schedule C. It says profit or loss from farming, but just like Schedule C, it gets filed with Form 1040 and it lives on the owner's personal tax return. Looks very similar to Schedule C, right? So it's 2 pages, looks very similar concepts. Farmers are just subject to some different tax regulations than the general public. So Schedule F is going to look a little bit different. Now, there are some sole proprietorships that may live on the first page of Schedule E. And this right here is going to be income or loss from like rental real estate and royalties. So rentals generally sit on Schedule E, not always, but generally they'll sit on page 1 of Schedule E right here. So if you have like a single family home that is a long-term rental that you're renting out, it's probably going to go here on Schedule E on page 1. Okay. So that's the first type. Now, just like a sole proprietorship, if we have, you don't have to have a formal business formation to be a partnership. A partnership just simply means that you have 2 or more owners and you're not a corporation, okay? So if you don't have a formal business formation or a formal legal entity, and if you are an LLC and you have 2 or more owners, okay, you are by default a partnership. A lot of people get tripped up with this. They don't realize they're a partnership. And partnerships are expensive tax returns to prepare. The reason being is because we're going from a Schedule C, which starts at 2 pages, to a Form 1065. So partnerships file Form 1065. This is on the federal level, obviously. Everything I'm talking about in this video is federal. I'll briefly touch on state and local here in a little bit. everything is going to be federal. So this is Form 1065, and this is the U.S. return for a partnership. And this is an informational only return. Generally, partnerships don't pay income tax at the partnership level. What ends up happening is when we have 2 or more owners in a business, we have to divvy up the income among the owners or divvy up the loss. And then this Form 1040 is prepared. So what we do is we prepare it for all of the owners here. So this is for the entire business. All owner shares are included in this. This is the business as a whole. We prepare income, we look at deductions, we have the ordinary business income or loss. We have a lot of additional information that is added here. We end up going down and we will have a balance sheet. We will have reconciliation of income or loss for the books, an analysis of partner capital accounts, all that good stuff. But what ends up happening is right here, the Schedule K. This on page 5 is for the whole entire partnership itself. But then we take the information here and we divvy it up to each partner. And each partner ends up receiving a Schedule K1. And that Schedule K1 is going to tell them what their share of different items from the partnership return are. So it's going to divvy up the income, the loss, all of the different items that sit on the partnership return. So we may have investment income, we may have some, different Section 179 deductions, that kind of stuff. It gets divvied up to each partner. And then that partner takes their Schedule K1 and they actually go to Schedule E of their personal return, page 2, Part 2, and they fill out this income or loss from partnerships and S corporations. So they're going to have a partnership and they claim the income on their personal tax return. What ends up happening is they claim their share of the income or the loss, and then they pay tax on that income at the individual partner level. Partnerships are what we call flow through entities. The income flows through onto the personal tax return of the partners, and that's where income tax is assessed. Generally, partnerships do not pay income tax. Now, that's a partnership, and partnerships can be extremely flexible. They're a very common type of business. Let's go now to corporations. So if you form a corporation at the state level, it is going to be by default taxed as a C corporation. C corporations are a completely different beast from all other types of businesses, okay, when it comes to tax. C corporations like Apple, Google, those kinds of companies are C corporations. And so a lot of people think, oh, well, these are large companies. You can have a small C corporation. There's nothing stopping you from having a small C corporation. C corporations are not as common for small businesses, but there are certainly small C corporations out there. They don't have to be publicly traded. You can have a privately held C corporation. Those exist, okay? C corporations are completely different because C corporations are going to pay income tax at the corporate level for federal tax purposes. C corporations pay income tax at the federal level, whereas all other businesses are flow-through entities or pass-through entities, which means all the income gets passed through onto the owner's personal return. C corporations are not like that. C corporations pay income tax on the income earned in the C corporation. C corporations file Form 1120, and this again is going to look very similar to your Form 1065 for partnerships. It just is a little bit different. We are generally going to have tax due here. So this is a C corporation tax return. We have some different schedules, but it looks very similar. We have Schedule K. We are going to have balance sheet. We are going to have reconciliation of income and loss per books. And then we have an analysis of unappropriated retained earnings, which is kind of similar to a capital account. So looks very, very similar to these other tax returns. It is just a completely different beast. Almost well, all C corporations are going to pay tax if there's income there at the federal level, almost all, unless there's deductions and that kind of things and credits that they're taking advantage of. But this is a C corporation return. If you file or if you form a corporation at the state level, by default, that corporation is going to be taxed as a C corporation, okay? So when we look at legal entities, anything that is not formed as a corporation is by default going to be taxed as a sole proprietorship or a partnership. Anything that is formed as a corporation is by default going to be taxed as a C corporation, okay? Really important that you know your default tax status. Now, LLCs and other formally formed businesses can elect to be taxed as C corporations as long as all the requirements are met. So you can actually have an LLC that is taxed as a C corporation, okay? That is a thing, it exists, we see it all the time. An LLC or another sort of legal entity can elect to be taxed as a C corporation as long as all regulations are met. So those are 3 of our 4 types. I'm going to cover a hybrid now, and that is an S corporation. An S corporation is not a default tax treatment for any sort of entity. You have to elect to be taxed as an S corporation, okay? You have to elect to be taxed as an S corporation at the federal level. S corporations are a hybrid between a C corporation and either a sole proprietorship or a partnership, okay? S corporations generally don't pay income tax at the corporate level, so they are a pass-through entity, but they are going to limit self-employment tax, which we will go over when we discuss S corporations. S corporations are a really big fad right now in small business taxation in the US. The reason being is because there are ways that you can save money with an S corporation. However, I want to caution you about electing to be taxed as an S corporation without truly understanding what the requirements are, because we commonly see people who elect to be taxed as an S corporation and it was a bad idea and it ends up costing them more in the long run. So while an S corporation seems like a great option, if you don't make an informed decision, it's not. It's not always a great plan, okay? S corporation tax return looks very, very similar to partnership and a C corporation. Okay, so this is the S corporation tax return. Very similar. Again, you're gonna have the Schedule K, you are gonna have a balance sheet, you're gonna have a reconciliation of income or loss, and you're gonna have an analysis of accumulated adjustments, which is again, like a capital account. It's like partnership accounts. So this looks very similar. Just like a partnership, Schedule K1s are issued to the shareholders in the S corporation, and that income is then picked up in Part 2 of Schedule E on each shareholder's personal return. So the S corporation return is an informational return. Generally, there's no tax due. The information is divvied up between the shareholders based on ownership, and then a Schedule K1 is issued to each shareholder, which then goes on to Part 2 of Schedule E. So the income tax for S corporations is generally paid on the owner's personal tax return, okay? Now, what we talked about was the federal tax treatment of these entities. We have not discussed state and or local tax treatment. I'm not going to go into each state because that would take forever. However, generally what you'll find is that the state tax treatment is reliant on the federal tax treatment of the business. Okay, so generally you'll start with the federal level tax treatment, and then you'll go to your state regulations and you'll look to see how that type of federal entity is taxed from a state standpoint. Okay. Local, there's some states that have local taxes, either like cities or school districts or county, that kind of thing. The way that income is taxed from businesses is generally going to start at the federal level. Generally, we don't see it start at the state level and then go down to local, which is kind of weird. We generally see it determined by the federal level tax treatment. It then flows through into the local, and then your tax specific ways at the local level based on federal treatment, okay? So there are, as a review, there's 4 different types of tax treatments for for-profit businesses. Sole proprietorship is going to be the simplest one. It is the default tax treatment for an LLC or any non-formally formed company that has one owner, okay? Partnerships are going to be the default tax treatment for LLCs or a business that's not formally formed with the state with 2 or more owners, okay? A C corporation is the default tax treatment for corporations. So if you form a corporation in your state, the default tax treatment is a C corporation. Now there are certain states where you elect to be taxed as an S corporation at the state level. You have to be careful with that because there's a federal S corporation election, okay? So just because you elect with the state does not mean that you're taxed as an S corporation at the federal level. Then we have this weird hybrid that you have to elect into, which is an S corporation. And that S corporation, there's no business that is by default taxed as an S corporation. It's an election that you make at the federal level. And it has kind of a hybrid tax treatment between a C corporation and either a partnership or a sole proprietorship. Those are the 4 different types of tax treatments. It's really important to understand how you're taxed. It's also important to understand the options that you have, because the way that you are taxed determines how you as an owner pay yourself. It determines how you set up your bookkeeping. It determines what tax forms you file, the due dates. It determines where tax is being paid from. It determines our estimated tax treatment. It determines who should and should not be on the payroll. It determines all sorts of things. It's gonna determine your state and local filings if you have any. The way that your business is taxed it also sets the standard for whether or not you need to register with the IRS. Really important that you understand how this works and then also understand your options. During the next 90 days, we're gonna go over the different types of taxes that are assessed to these different types of entities. We're gonna go over what that looks like, how that works, so you can be better informed on how you're being taxed, and then if you want to be taxed a different way and what that looks like. But in general, there's 4 entity types. There is kind of this random hybrid entity type called a qualified joint venture I didn't touch on. Qualified joint venture is only going to be for a business with 2 owners. They must be legally married. And a qualified joint venture essentially removes the requirement for a partnership, and it allows you to file 2 sole proprietorships instead, split between each spouse. Qualified joint ventures have some different requirements as far as if you are an LLC, probably not eligible to file as a qualified joint venture. That depends on whether or not you're in a community property state. Really rare that we see qualified joint ventures. And in all reality, it's essentially 2 sole proprietorships. You split the business activity into 2. And then you file 2 sole proprietorships rather than a partnership return. It just essentially saves you from having to file this massive partnership return, because this partnership return starts at 6 pages. It is not 6 pages alone. In reality, it starts at 6 pages, and then you have the Schedule K-1s, which are going to be 2 to 3 pages minimum each. So we're already up to, you have to have at least 2 partners. We're already well past 10 pages. There's a bunch of supporting documentation that goes with it. Partnership returns are not simple. So that's where the qualified joint venture steps in, but it's really only going to be applicable if you own a business with your spouse, there's no other partners in it, and you're actually eligible to file as a qualified joint venture. Hopefully that was helpful. If you have any questions, let me know. And then tomorrow we will be discussing actually registering your business with taxing authorities. So do you need to register with the IRS? What does that look like? How do you register? How do you open tax accounts with different states, different localities, all that good stuff, and just making sure that you're getting yourself set up to properly file taxes. So I will see you guys next time.